So listen here. So we start with the chapter on departmental accounts. Now wherein you'll be asked to prepare a department trading account, or they might ask prepare a department trading and profit and loss account. The reason for preparing a department trading and P&L, I want to know what is a profit from each segment, or say each division of my firm. Now what happens, sometimes there will be a loss-making division. Now I can decide whether to reconstruct or restructure that particular division, or in case a division is beyond repair, where you don't see any profit coming from that division, what you can do? You can shut down that division. Okay. And that is the reason you want to ascertain the profit or loss, okay, made by each department. And so now, over here in this example, you have been asked to prepare a departmental trading account. First of all, if you notice, it's given that they are given the units are bought by each department. The departments are A, B and C, and they purchased goods for rupees 6 lakh. But the 6 lakh rupees has not been apportioned. They are given that all the three departments bought goods for rupees 6 lakh. But the 6 lakh rupees amount has not been split between the three departments. But there's a very important clue that is given in the question, that the rate of GP, the rate of gross profit on sales, is uniform or is the same for the three departments. Remember, it's not the amount, it's only the rate of GP is the same for each department. Now, how do you calculate GP normally? You take sales minus your cost of goods sold is what? Is your gross profit. But here the problem is, we have the cost of goods purchased, not the cost of goods sold. Now what I can assume is, to find the rate of GP, I'll assume that all units purchased are sold. If all units are bought, are sold, now what is the amount of revenue I will earn? For example, now how many units are purchased by department A? 6,000 units. If these units are sold by department A at the selling price fixed by them, how much? At 40, they will earn rupees 2,40,000 in revenue. And then department B, now how many units are bought by them? They purchased 12,000 units. If these units are sold at the selling price fixed by them, how much? Which is 45. Now what is 12,000 into 45? I will earn another 12,000 into 45 is 5,40,000. 5,40,000, right? And then what about department C? 14,400 units, and that into 50 each, 7,20,000. Now if you sum it up, that is 2,40,000 plus 5,40,000 plus 7,20,000. It adds up to rupees 15 lakh. That means 6 lakh rupees goods purchased can be sold for how much? 15 lakh. So 9 lakh rupees will be the profit earned, okay, by the firm if all goods purchased are sold. The 15 lakh rupees and 6 lakh rupees are comparable because, why? What is 15 lakh? It is a sales value of quantity purchased. And what is 6 lakh? Cost of goods purchased. If all goods purchased are sold, I'll make a 9 lakh profit. So what is rupees 9 lakh upon 15 lakh? 60% is my rate of GP on sales. And it's very clearly given that this rate is earned by all the three departments. Now what I can do is, I have the selling price for department A, how much? Given as 40. On that I'll apply 60%, which is my profit, 24. And 40 minus 24, how much? 16 becomes what? Is my cost per unit. From the selling price, you remove the profit, you will get the cost price or the purchase price per unit. And you can do that for department B and C as well. And once you get the purchase price or cost per unit, okay, then I can go ahead and value the units bought at the cost. And then, so one more issue. Now how are you going to value the opening and closing stock? Definitely at what? Cost. At cost. Okay. And that is what Accounting Standard 2 says. You're supposed to value the inventory at cost or NRV, whichever is less. Okay. And since the NRV is not given, we'll assume what the cost is definitely less than what? NRV. Okay, at cost. But how to value the opening stock? What is opening stock? Is last year's closing stock. So what is the last year's purchase price? So you got to assume that even in the previous year, you bought the goods at the same price at which you're buying the goods in the current year. Now, since the data regarding the previous year purchase price is not available in the question, so you got to assume that even in the previous year, you bought the goods at the price that is prevailing in the current year. Fine. Now listen. But the opening stock, first of all, the units are not given, I suppose. They're given the units sold by the departments, and they're given the closing stock units are given, and they're given the units bought in the current year, but not the opening stock. And that is no big deal at all, okay? Now tell me, department A, how many units are sold? They sold 6,120 units, and they still have how many units in stock? 600. That means, they should have had 6,720 units in all before making any sale. They sold 6,120 units, and after selling 6,120 units, they still have 600 units on hand. That means what? They must have had what? 6,720 units. Of these 6,720 units available, how many units are bought in the current year? 6,000. That means 720 should have been your opening stock. You get it? So now you want to have a formula, sales quantity, add a closing stock units, minus units purchased, will give what? The opening stock units. And then you can start with the department trading accounts, wherein you show 2 opening stock, then 2 purchases, then buy sales, and buy sales will be what? The actual number of units sold into selling price per units, and then buy closing stock, and the balancing figure will be what? Your GP. You get it? So when you prepare the department trading account, do not assume that all units are bought or sold. You take the actual quantity sold. Example, 6,120 units are sold by department A at rupees what? 40 each. And that is the amount to be shown in department A as sales. But initially we're going to make an assumption that all units are bought. Okay, if sold, what is the profit? Because my objective are, you can say, or it's our objective is to what? To calculate the rate of GP. You get it? Now let us start with some working notes, and then you can go ahead and prepare a departmental trading account. Wait. This chapter will be later, now we'll walk into examples where there are inter-department transfers, where the goods are transferred from one division to another division, not at cost, at selling price. So then what is the issue? Okay. Now when these goods transferred are not sold, then what happens? How do you tackle the inter-department transfers at selling price? Now how do you create a stock reserve against such goods that are not sold, right? So those are the issues in departmental accounts. Let us start with this example. Please write working note number 1. So write working note number 1. I write the heading as a computation of working note number 1. I write the heading as a computation of rate of GP. Computation of a rate of gross profit. And then under that working notes, so under this working we've got subdivisions. Okay, subdivision 1. Write subdivision 1 and you construct a 4-column table. The column heads are departments. Under working note 1 is subdivision 1. It's a 4-column table. The column heads are department. The second column units purchased. And then the third column is selling price. The fourth column is the sales value. That is sales value of what? Of units purchased. And this statement is prepared on the assumption that if all units bought are sold. And this is only to find the rate of GP. So now write under department it is A. And second column is 6,000 units. And third column the selling price how much? 40. And last column is 2,40,000 amount. And then the next. Somebody is very happy, whistling. And department write B. And units purchased are 12,000. And selling price how much? 45. And last column is 5,40,000. And right under department it is C. It is 14,400 units. And selling price rupees 50 per unit. And then the last column is 7,20,000. So then you make a total of the last column that works out to rupees 15 lakh. So rupees 15 lakh is my, what is that? Sales value of units purchased. Okay, so now write subdivision 2. Write subdivision 2, the same note. You can write cost of goods purchased. Write cost of goods purchased equals the amount given. How much? Rupees 6 lakh. Then write subdivision 3. Write amount of GP, the amount of gross profit. But remember this amount of GP on the assumption that all units purchased are sold. Okay, amount of GP equals, that is 15 lakh, which is supposed to be the sales value of units purchased, minus 6 lakh. That is the cost of goods purchased. That means rupees 6 lakh worth of goods purchased can be sold for how much? 15 lakh. And how much profit you're going to earn is equal to rupees 9 lakh. And then the last subdivision, subdivision 4, the same working note, right? The rate of GP, the rate of GP, that is on sales, okay, it's understood. On sales equals, it is 9 lakh, rupees 9 lakh divided by rupees 15 lakh into 100 as a percentage. And that is equal to how much? 60%. So you can say that the rate of GP is 60%. There is 60% on sales. So I'm done with working note number 1. Now write working note number 2. Working note number 2. So write working note number 2. I write the heading as a computation of working note number 2. I write the heading as a computation of the total cost of goods purchased by each department. The total cost of goods purchased by each department. So under this you construct I repeat, working note number 2 is computation of total cost of goods purchased by each department, and you construct a 6-column table. The column heads are number 1, department. The second column is units purchased. The third column is selling price. Then the fourth column is profit per unit. Write profit per unit. And fifth column is cost. Write cost or purchase price per unit. It's cost per unit, or you can write purchase price per unit. And the last column will be write total cost. Write total cost. I repeat the column heads. Just check departments, units purchased, selling price, profit per unit, the cost or the purchase price per unit, and total cost. Now write under department, you write A. Under department you write A. And then the second column, it is 6,000 units. 6,000 units purchased. And the selling price is rupees of 40 per unit. And then the fourth column, what is that? Yeah, selling price is 40 and the profit is 60% on 40. The gross profit is 60% on 40. How much? 24 per unit. And what is the cost? 40 minus 24. How much? 16 per unit. And the last column will be 6,000 units are purchased at rupees 16 each. So rupees 96,000 is entered in the last column. Rupees 96,000. And right under department it is B. And write 12,000 units are purchased. Units bought 12,000. And then the third column is how much? It is rupees 45 per unit selling price. And what is the profit? It is 45 into 60%. How much? Rupees 27 per unit. And next, rupees 18 per unit, the cost. And then the last column is 12,000 units into 18. How much? Okay, 2,16,000. 216. Okay, 2,16,000 rupees in the last column. So now write under department it is C. And how many units are bought? 14,400. And selling price 50. And then the profit once again 60% on 50. How much? rupees 30. And what is the cost? 20. And the last column, 2,88,000. And if you total the last column, okay, you shouldn't be surprised. It should add up to how much? 6 lakh. It will add up to 6 lakh. That is rupees 96,000. Rupees 96,000 plus 2,16,000 plus. Now listen. Now since your GP is 60% of sales, you can say that your cost is 40% of what? Sales. That is the meaning. If somebody says my profit is 60% of sales, that means your cost is 40% of what? Your selling price or sales. Now tell me in the first working note, how much is shown as sales for department A? On 2,40,000 apply 40%, you will get 96,000. Because the 2,40,000 nothing but the sales value what? Units purchased. If you remove 60% from that, the profit element, you'll get what? Cost. 96,000. And how much is shown for department B? On that you take 40%, how much? You will get 2,16,000. And what is for department C? On that 40% will translate to rupees 2,88,000. But remember, in this working note, that is working note number 2, even the one column before the last column, what is that? The cost per unit is also relevant. The reason is we'll be valuing your opening stock also what? And closing stock at rupees how much? 16 for department A, at rupees 18 for department B, and at rupees how much? 20 for department C. And one more working note, then you can start the department trading account. Right? Working note number 3. And you write the heading as it's computation of opening stock units. Right, a computation of opening stock units. Okay, so now you construct a 4-column table. The column heads are particulars, and the second column department A, third column department B, and the fourth column department C. So particulars, the departments are A, B and C. Okay, so now write under particulars the first line. It is a sales quantity. Write a sales quantity and write 6,120 for department A, and then 11,000. Okay, 5, 20 and 14,000, 976. 14,976. And then write add closing stock units. Add closing stock units. It is 600. Then 960 for B. And then 36 units for C. And then now write a less. Units purchased. Less units purchased. The numbers are 6,000, 12,000 and 14,400. Now you balance the columns. You get it is 720 units, 480 units, 612 units, and against these numbers you write Against these numbers you write opening stock units. Now listen. Now how are you going to value the opening stock? For example, department A, I'll take 720 units into rupees 16 each. What would be 480 units into rupees 18 per unit, the cost. And then what about C? I will take the opening stock 612 into rupees 20. And listen, 2 purchases, whatever amount you have in working note number 2, how much? 96,000, 2,16,000 and 2,88,000. They're on the credit side. You will enter sales, actual sales. 6,120 units are sold at rupees 40 each. And so on, right? And then by closing stock, whatever units given into rupees 16 at cost and into rupees 18 for B, and then rupees how much? 24. It is 16 for A, 18 for B, and 20 for C. And the balancing figure will be a gross profit. Will you complete? So go ahead and prepare a department trading account.